In volatile markets like crypto, losses are not the end, they are a diagnosis. True recovery doesn't come from emotional reactions, desperate attempts to make it all back at once, or even riskier bets to offset losses. It begins with one essential exercise: carefully reading the market cycle. When the market shifts sand, it always does the fundamentals that supported your portfolio. Yesterday may no longer hold true today. Liquidity tightens, asset dominance reshuffles, and many projects that once seemed promising lose relevance, utility, or institutional backing. In this new environment, holding exposure to assets that no longer justify the risk isn't loyalty, it's strategic negligence. Rebuilding wealth requires more than capital. It demands intellectual discipline and operational humility. The first step is an honest diagnosis. Where did you go wrong? Was it over-speculating in altcoins with no real utility? Ignoring macroeconomic signals? Confusing hype with adoption? Overestimating the resilience of projects with weak governance or unsustainable tokenomics? This exercise isn't about punishment, it's about future calibration. Every mistake, when properly understood, becomes a sharper filter for your next decisions. The second step is structural adjustment. This means reassessing portfolio weights, reducing exposure to low-conviction assets, and correcting emotional excesses such as dangerous concentrations in meme coins or blind bets on narratives lacking technical substance. This isn't about panic selling everything, but about realignment to the current market reality. In phases of deleveraging and risk aversion, for instance, focus should shift to assets with deep liquidity, proven institutional adoption, solid fundamentals like Bitcoin and Ethereum, rather than speculative ventures with low volume and high correlation to short-term sentiment. The third and most critical step is to resume investing with balance, not impulse. Recovery doesn't happen by chasing your own tail, pursuing prices that have already passed, or trying to catch the bottom with surgical precision. It happens through consistency, patience, and discipline. This includes reinstating strategies like dollar-cost averaging DCA, even amid discouragement, and respecting predefined risk limits. The goal isn't to recover losses in 30 days, but to rebuild a resilient portfolio, aligned with the current cycle and prepared for future ones. But how do you identify the current cycle? The answer lies in objective signals, not opinions or social media trends. There are 4 foundational pillars: capital flows, especially into institutional ETFs, which now drive much of the structural demand; funding rates in derivatives markets, which reveal whether there's excessive leverage on the long or short side; on-chain data, such as whale movements, long-term show dealing, and exchange inflows, which anticipate selling pressure or silent accumulation; macroeconomic conditions, Fed monetary policy, global liquidity, the US dollar; real interest rates, and geopolitical risk factors that shape risk appetite at a global scale. When these signals are monitored together, it becomes possible to discern whether the market is in a phase of accumulation, distribution, euphoria, or capitulation, and position your portfolio accordingly. In November 2025, for example, with Bitcoin below $90,000, negative ETF flows, OG sell-offs, and still elevated interest rates, the cycle is clearly not one of expansion, but of redefinition and selection. In this environment, only assets with real utility, solid governance, and active communities survive, not those relying solely on fleeting narratives. This cycle alignment demands, above all, emotional detachment. Many investors remain anchored to their entry prices, as if the market owed them respect for their average cost. But markets have no memory. They only react to the present and anticipate the future. Accepting smaller losses to avoid greater risks isn't weakness. It's professional risk management. Moreover, the temptation to double down on fallen assets, the emotional version of the martingales, one of the most destructive traps. Even a strong asset in a liquidation phase can drop another 80% before recovering. Without fresh capital and proper timing, this strategy can lead to total ruin, not recovery. Thus, intelligent diversification is essential. It's not about scattering resources randomly, but about building complementary exposures. Store of value assets, BTC, network infrastructure, ETH, SOL, and perhaps a small, higher-risk innovation coral with clear allocation limits. This way, even if one segment suffers, the whole remains stable. Furthermore, time is only an ally for those correctly positioned. Staying in assets with no flow, no development, and no active community isn't hodl, it's passive waiting without foundation. True HODL is based on conviction renewed daily by facts, not nostalgia. Recovery also requires self-awareness. What is your true risk profile? Can your strategy withstand a 30% drawdown? Can you sleep peacefully with 80% in altcoins? Answering these honestly prevents impulsive decisions at the first sign of volatility. Historically, the biggest gains in crypto came not from those who bought at the start of a bull market, but from those who preserved capital and clarity in the final phase of a bear market. In 2019, while many believed Bitcoin would never return to $10,000, those who understood the post-halving cycle was already forming began accumulating. In 2023, after the FTX collapse, those who looked beyond the fear saw that regulatory infrastructure was strengthening and positioned themselves ahead of ETF approvals. Today, in 2025, we're in a similar moment. Widespread disbelief, yet stronger fundamentals than ever. Bitcoin has never had more institutional adoption, more regulated liquidity, or deeper integration with traditional finance. The current correction isn't an apocalypse, it's a cyclical cleanse, eliminating speculators and strengthening true believers. In this context, investor psychology is just as important as technical analysis. Studies show that most real losses stem from poor emotional management, not asset volatility. Panic selling, FOMO buying, changing strategies with every tweet, these behaviors destroy wealth far more than 50% drawdowns. That's why you must establish clear rules. What's my maximum loss limit per asset? Which indicators prompt me to reduce exposure? Under what scenarios do I pause new investments? With these rules, you turn uncertainty into process and fear into method. Finally, remember, great crypto fortunes aren't made during exponential rallies, but during deep corrections when few have the vision, liquidity, and composure to position intelligently. If you use this moment not to panic, but to rewrite your strategy based on real market signals, you won't just recover losses, you'll be planting the seeds of the next growth cycle. And in this game, those who understand the cycle always beat those who follow the noise.